Insurance works by turning one persona Euro's large uncertain loss into many people Euro's smaller predictable payments. The process works because policyholders pay premiums into a system, and the insurer uses pooled money to pay covered claims. You can see it when thousands of drivers paying premiums so the few who crash can receive repair support. This matters because insurance is risk pooling, not a personal savings account. The premium is the price of transferring risk. The hidden lever is that insurers estimate how likely a loss is, how expensive it could be, and how much administration and profit are needed. For example, a young driver with accident history paying more than an experienced driver with a clean record. So the useful takeaway is that premiums reflect risk estimates, not only generosity or punishment. A policy is the contract that defines the promise. The moving part is this. It states what is covered, what is excluded, when coverage applies, how much can be paid, and what duties the customer has. A simple example is home insurance covering sudden pipe burst damage but not every type of gradual leak. The result is that the written policy controls the claim more than casual assumptions. Deductibles keep small losses with the customer. What changes the outcome is that the insured pays the first part of a covered loss, and the insurer pays the eligible amount above that. A realistic case is a car repair costing $1,200 with a $300 deductible, leaving the insurer to consider the remaining $900. That is why insurance is usually designed for meaningful losses, not every minor inconvenience. Coverage limits cap the promise. In real life, even a valid claim may be paid only up to the maximum amount shown in the policy. One ordinary version is jewelry worth $20,000 being covered only up to a smaller special limit unless scheduled separately. The practical lesson is that covered does not always mean covered fully. Exclusions describe what the insurer will not pay for. Under the surface, excluded causes, situations, items, or behaviors remove coverage even when the loss is real. Think of a travel policy excluding certain adventure sports after an injury during an unsupported activity. The viewer should remember that a real accident can still fall outside the contract. Underwriting happens before the promise is priced or accepted. The practical engine is simple. The insurer asks questions, reviews information, and decides whether to offer coverage and at what terms. Picture a health insurer asking about age, medical history, and lifestyle before issuing a policy. Once you see that, underwriting is how the insurer avoids charging everyone the same for very different risks. Claims begin when a covered event may have happened. Mechanically, the customer reports the loss, provides details, submits documents, and cooperates with review. This shows up when, after a kitchen fire, the homeowner sends photos, fire report, repair estimates, and proof of damaged items. That small detail changes the decision because documentation turns a story into claim evidence. Adjusters investigate the amount and cause of loss. The process works because they compare the damage to policy terms, inspect evidence, and estimate eligible payment. You can see it when a car adjuster checking whether damage came from the reported accident or older unrepaired dents. This matters because claim review is about both what happened and what the contract covers. Insurance companies must manage fraud risk. The hidden lever is that false claims raise costs for the pool and can make premiums higher for honest customers. For example, someone exaggerating stolen items after a burglary and triggering extra verification. So the useful takeaway is that some claim questions exist because the system has to protect the shared pool. Insurance does not remove every financial burden. The moving part is this: deductibles, limits, exclusions, depreciation, waiting periods, and uncovered items can leave out-of-pocket costs. A simple example is a phone insurance claim approved but reduced because the policy applies depreciation to older devices. The result is that insurance reduces risk, it rarely eliminates every cost. Renewal is not guaranteed to be identical. What changes the outcome is that premiums, terms, limits, or eligibility can change after claims, market losses, inflation, or new risk information. A realistic case is home insurance premiums rising after a region experiences repeated flood losses. That is why insurance pricing responds to both personal and broader risk. Different insurance types solve different risks. In real life, health, auto, home, life, liability, travel, and business policies each have their own triggers and limits. One ordinary version is life insurance paying after death, while health insurance pays eligible medical expenses during life. The practical lesson is that the policy must match the specific risk you are trying to transfer. Cheap insurance can become expensive after a loss. Under the surface, a low premium may come with high deductibles, narrow coverage, low limits, or broad exclusions. Think of a business choosing the cheapest liability policy and later discovering a common risk is excluded. The viewer should remember that premium should be compared with protection, not judged alone. The customer also has duties. The practical engine is simple: accurate disclosure, timely payment, loss prevention, prompt reporting, and cooperation can affect coverage. Picture a claim delayed because the policyholder waited too long to report theft and key evidence disappeared. Once you see that, insurance is a two-sided contract, not only a payout promise. A practical way to read insurance is to imagine a claim. Mechanically, ask what event triggers coverage, what evidence is needed, what limit applies, what deductible applies, and what exclusion could block payment. This shows up when testing a home policy by asking exactly what happens after sudden water damage. That small detail changes the decision because claim scenarios reveal gaps faster than marketing brochures. Insurance is useful when the loss would be painful enough to disrupt your finances. The process works because small predictable costs may be self-managed, while rare large losses are better transferred. You can see it when paying routine maintenance yourself but insuring against a major car accident or house fire. This matters because the best insurance protects against risks you cannot comfortably absorb. Insurance works when the contract, the risk, and the expectation match. The hidden lever is that problems usually appear when people buy a policy without understanding what risk was actually transferred. For example, a person expecting every travel problem to be covered when the policy only covers listed events. So the useful takeaway is that the safest buyer reads insurance as a precise promise, not a general feeling of protection. Insurance works because many people pay into a pool before losses happen. Most people will not have a major loss in a given year, but a few will. The premiums from the many help pay the claims of the few. That is why the insurer cares so much about pricing risk correctly. If the pool is priced badly, the promise becomes hard to keep. A simple example is car insurance. One careful driver may pay premiums for years without claiming. Another driver may crash in the first month. The company cannot know exactly who will have the accident, but it can estimate risk across thousands of drivers. Age, driving record, vehicle type, location, and coverage level all help shape the price. The policy is the boundary of the promise. It explains what kind of loss is covered, what is excluded, how much the insurer may pay, and what the customer must do during a claim. This is why two people can both say they have insurance, but receive very different outcomes after similar damage. Their policies may not promise the same thing. The clearest way to understand insurance is this: you are not buying a guarantee that nothing bad will happen. You are buying a conditional promise for certain losses under certain rules. Good insurance planning means knowing the risk you are transferring, the risk you are keeping, and the paperwork needed if the bad day actually arrives.